joining us. I'm going to introduce our esteemed speaker, Julie Dupont-Nedelec. So Julie has, Okay, Julie has worked across the capital markets and financial credit for the past 25 years. And within that 25 years, she spent the last 10 years of that actually designing and delivering middle office and back office solutions for private credit managers. She's also held senior roles at major financial institutions, such as BNP Paribas, Lloyds, Dresner, and Nomura. And she has deep expertise across the life cycle of the financial markets. She has also worked with private credit managers to deliver innovative solutions for client requests. These are the dates. Julie is passionate about technology, as you can see here, technology and innovation, and she also sits as a treasurer on the board of the London Capital Credit Union. So I'm going to call on Julie now to give us our presentation.
I'd like to start with a little survey for the online people as well. Now it's talking to a room full of IT people. I'm not sure how it's going to go, but bear with me. Please raise your hand if in the last 24 hours you have used AI personally to make your life easier. Me too. Now, cast your mind back to exactly a year ago and try to recall how you would have answered that question then. Oh, it worked. Okay, right. This is the illustration of how quickly AI has kind of invaded our individual lives, and how we certainly expect that this is the same in the industry of business and finance and so on. And we'll find out that we may be quite familiar ourselves, but to make it institutional, it's a different story. As Chikezi introduced me, my name is Julie Dupont-Nedelec, 25 years experience in financial markets, specializing in structured finance and private capital solutions. And yes, over the last 10 years at BNP Paribas, I've been delivering private capital solutions to large asset managers, mainly in the private debt space. So tonight we're going to explore how technology, AI, and automation are impacting the private markets investment. Private markets have grown 10% per year since 2014. It represents now $13 trillion of assets under management. And its main function or benefit is that it really powers through the real economy, because all of these investments goes into small businesses, SMEs, small, medium, mid-market, and also large corporate, always on a private basis. And this interesting aspect of it is that it actually operates from the same market and with the same tools that it finances. So a lot of this private investments goes into technology, and that technology needs to support that growth of investments. So how does the tech and AI impact this sector? First, we're going to look at a little bit of definitions of the space. Then we're going to look at the landscape in a bit more detail. Who are the players? Why do we talk about this so much? Like, where does the complexity come from? And specifically, we're going to look at private debt. It's my favorite, and also because it's really where the data problems become so, challenges become so obvious. And finally, naturally, we'll see how technology and AI can help to solve these challenges and support efficiency and growth in the sector. But also, we know that there are obstacles to adoption. There are queries about security. There's the human factor into this to take into consideration. So we dive in, and sorry. We look at some definitions. It's maybe obvious to everyone since you're here, the private markets, but I don't know if some of you are less familiar. So we'll go simple definition. The private markets is all investments that are not traded on public markets. So really, it's no London Stock Exchange, no Bloomberg ticker, no public share price. If you want to know, you have to be an investor into that fund or into that specific company via the fund. Private markets includes private equity, private debt, and what we call real assets. So that's infrastructure and real estate. Yeah, I'll stop there. Sorry.
Just on that, so you'd include like family wealth would be under that, but not BlackRock and things like that, or BlackRock's got 12 trillion under.
BlackRock has a very big share of the private capital. Absolutely, BlackRock has runs private equity funds. They actually also run BlackRock Solution runs technology for the administration of private capital funds. It's called eFront. So they're really very invested, and we'll talk about that later. We'll see like there's various sizes of. We'll go through that the players, the investors, the managers, the service providers, and so on. But just a general view on the strategies we see to some extent still forms part of the private market. We got growth strategy, distressed opportunity, and so on. And the size of the companies that get financed through this market can be from the very small micro financing to SMEs, mid-market, which is it's kind of the bigger size of the small market. Sorry. And even large corporates. So I'll give you some examples of these funds, PE funds that you may have heard of. KKR, for example, Blackstone, Apollo, CVC. These big names, they lead multi-billion dollars investments in technology, healthcare, infrastructure, logistics. But these are the kind of investments we're talking about, but also smaller funds focusing on very smaller businesses in the real economy. On the private debt side, you have other names such as ICG, Alcentra, CVC has a credit branch. There's Arcmont, Nuveen, they're also quite big in Europe and in the US. So that's kind of the general overview. In terms of market size, so we said current AUM is about 13 trillion, with predictions that by 2030 we could be as high as 20 trillion. So it keeps growing. A slight slowdown after the COVID time. So a real boom and then slow down because of economic factors and so on. But there's still a lot of capital flowing into the market. And in particular, there's two areas of private markets that really keep going up. That's infrastructure. Why? Because that's where you find all the technology investments, the investments in data centers, the investments in broadband networks, and so on. And also in the infrastructure sector, you've got all the renewables. Investments in renewable energy are continuing to grow. And the other area that's growing fast is the private debt. Even though, with the fact inflation and interest rates movements and so on, private debt is still a good place for investors to invest and also for companies to get their funding from, because of how banks are no longer lending the same way than they used to. It continues to be a good place and the yields are good, the diversification is attractive. So, it's a good tool for the economy and for investment. So just to note, these two together, infrastructure and debt, they're 20% of all the private markets. By 2030, there'll be 30% of that rate, of that share. So something to bear in mind. And what's happening also is that the private markets, that they are less and less specialized markets, because we see a lot of new capital coming in from especially retail sources. We'll talk about that. And that's also a big factor in that continuing growth. Now, we look at the landscape. What I mean by that is, just take a closer look at how the market operates, how the industry operates, who are the players, the challenges they face, and also the key trends. We talked about retail funding, for example, and we'll discuss that in more detail. But first of all, how typically private capital operates. They are typically closed-ended funds, which means investors bring their investments in the form of subscription. They commit to the fund for a certain duration, 5 to 7 years, and then they get a redemption. The reason for that is that the capital needs to be locked in to some extent in order for the managers to really have the time to work with the businesses to operate the transformation, bring leverage, generate new dividends, and eventually create a capital return. So really, it's a long-term investment. One mechanism also that's to keep in mind with this subscription and redemption mechanism is that investors will commit a certain size of investment, but that investment is not drawn immediately. It comes in the form of capital calls with different timings and different closings and so on. And keep in mind all these details I'm bringing because they impact the fact that this industry tends to become very specialized and customized and bespoke and so on. Because it is, because the capital doesn't flow in and out, it's not liquid, you have to call it in and then redeem it at the right time. And of course, all of that is based on non-public data. If you're not an investor, or if you're not an investor, you don't know what's happening. What it means is that every contract from the fund investing into the business, or from the investor buying shares into the fund, or this subscription contract, all of these are private. They're really bilateral. So now we're going to talk about the market players. As we said earlier, typically it's this type of investments is more tailored for institutional investors. So we're talking large asset owners, insurance companies, pension funds, sovereign wealth funds, and also fund of funds. Why traditionally these are the target market for this type of strategy is because there is, as we said, illiquidity. You don't come in and out easily. There's minimum investment thresholds that are quite high. There's a complex fee structure and also a need for a certain understanding of the risk, of the long-term risk, which the regulator kind of stops and say, we don't go too far down the line, but that's changing. So to give you some examples of names you can come across on insurance, big allocator to private capital would be, AXA, Allianz, HSBC Life, all the big insurance names. Usually they have a private capital pocket. Pension funds, I'm thinking, for example, the Canadian Pension Plan Investment Board, CPPIB, CalPERS, the Californian private pension fund, public pension fund. These are big names whenever there's a fundraising, they're around the table and they invest. Sovereign wealth funds, anyone you can think of in the Middle East, ADIA, Qatar Investment Authority, in the Far East, the GIC for Singapore, the Norwegian government. Again, these are big names that get to sit around the table when there's a round of funding. And then we're talking also fund of funds. So there are specific investors such as HarbourVest or Pantheon. They are well known for investing into the creating funds out of shares into private funds. So again, that kind of adds another layer to the privacy of the data chain. So we mentioned briefly that we also have more and more funding coming from the qualified retail sources, which I want to talk about just a bit later. Next up in the main market players will be the asset managers. So that's when we talk about the BlackRock and the KKR, Apollo, and so on. They make the investment decisions, they gather the funding, they distribute the return, and they take management fees and carried interest in the middle. And that can be like some pretty complex and bespoke type of formula that the investors have to agree to together with the manager. In that category, I also want to add the banks, because banks provide leverage into these entities in the terms of capital call facility, advancing before the investor is able to deliver the cash into funds capital call, or NAV facility, again, bringing leverage on the net asset value of the fund. So combination of these two really enables the funds to operate smoothly and also maybe boost a little bit their return. So the banks would have Nomura, BNP, Bank of America. The big banks are also very involved in this market. Finally, the service providers, because those GPs, they operate, sorry, GP's general partner, that's the asset manager. They operate on a very lean operations usually, and they will just outsource the administration. So here, the type of services we're thinking of would be fund administration, fund accounting, middle office operations, cash management, financial reporting, investor management, onboarding, capital call, distribution, all those day-to-day operation into the fund. Again, it's not very liquid, but when it happens, it can get complex because each one has their share and so on. So in that category, you have big banks, BNP Paribas, for example, BNY Mellon, just some examples. You have specialist fund administration service providers like SS&C and Citco, and you've got a lot more tech companies or just kind of new entrants. In terms of tech companies, I've got Allview, Broadridge. We mentioned eFront, which is developed by BlackRock. So these are all examples of the types of players that are in this market. So it's very diverse. Now, so far, we've got the players and the general mechanism. But if you then think about the various complexity that can be overlaid, you can have for each strategy several investment vehicles with different strategies. They can be in different jurisdictions. You can have an investor who has a specific strategy and will require SMAs, segregated managed accounts. You've got co-investment vehicles that take up the kind of overflow of funds where some criteria has been breached, but we still want to invest. They're going to co-invest. So you imagine a constellation of vehicles with each requiring their own reporting and their own applying their own strategy and so on. Now look at this from the perspective of the investor. You've got a large insurance company with numerous strategies, some liquid, some illiquid, different instruments and so on. So they also need to receive the information and integrate it into their reporting and to comply with their regulatory requirements for transparency and so on. So with that, you can start to measure the type of challenges that are faced by the industry, because again, the data at the start is not public. So it's this data is is siloed, is located in various systems of all these providers I've been telling you about. It's sometimes inconsistent, and the format is still in the form of PDF or Excel. It gets transmitted via email. It needs to be copied across and double-checked and so on. So really, hopefully you get a picture now. Still, this market is attractive, and new sources of capital are coming in. Mainly because the returns are still better than in the public markets, and the industry is still growing. So we have two types of new sources of capital. One, which we call the democratization, which is the retail sector looking in and saying, yes, we want a share of that. We want that return. We understand the strategy. Let's have it. Here there are some really interesting players. You know, you would have heard the name of Moonfair or iCapital. These are platforms that will connect individuals and pull them into investing into those big structures. I've come across also specific platforms such as ADDX or Hamilton Lane, and they seem to really go down to opening up these markets for private investors, but there's still certain thresholds in terms of capital size. And we see, for example, in the US, so regulations have opened up the 401k plans, so pensions can be invested in private capital. So that's been a real change into that space. And in the first half of 2025, there's been 48 billion extra funding coming into private credit from wealthy individuals, like high net worth retail. So it is happening. The other trend is the permanent, it's what we call permanent capital. So it's kind of going back to the more traditional view that this capital is long-term, but to make it even more secure, we see a trend for insurance companies to partner with managers in creating specific structures that have pretty much ongoing capital ready to be used and at, you know, whatever, you know, illiquid kind of space that there is. There's examples there of a recent partnership between Blackstone and AIG would be, you know, the one that you would come across. This is very, very key because it's estimated, this is a number from McKinsey, that up to 20% of the total AUM can actually be added to the numbers we see because of these new sources of funding. So it's, yeah, good to keep in mind. I mentioned that I was going to talk a bit about private credit because, you know, it's the growth engine for the market. It's also the big data headache. Private credit represents about 10% of the AUM at the moment, doubled in the last 5 years. So it is very fast and continuing. Private credit is the area of investment in private markets where the fund is actually the lender. So it replaces the bank. It lends on a bespoke bilateral or sometimes on the, you know, pooling lenders into a specific business. We also call it direct lending. So it's a generic name for direct lending, which is a bespoke type of lending. They also can be investments into corporate loans, which are a little bit more liquid, but they also fit into that credit space. Infrastructure loans are a very big part of this market as well. And the mezzanine lending, it was traditionally the start of the private debt space because it started when the banks retreated from lending after the financial crisis. They were not lending as far down the balance sheets. So these funds came in and said, no, we understand that, we can do mezzanine lending. So these are the main buzzwords for this market. So we talk, yeah, here's my little chart to try and make it really messy. So it looks messy. Why is it messy? Because these loans, by definition, they are bespoke, they're bilateral agreements, and they are, you know, agreed, signed on PDF formats. They contain all of the terms which have been negotiated. In particular, you're going to have terms around, you know, how the rate is set, how it's reset, the margins, the discounts, or the penalties. You're going to have specific covenants that need to be followed and monitored over the life of the transaction. These covenants, they are calculated based on information that comes from the company and need to be monitored on a regular basis. And if they're breached, something happens to the rate and so on. In addition, you get rate resets, there's drawdown, repayments, revolving facilities. All of this is to show you that in the private debt space, the management of the assets underneath is really much more involved. Here again, we have a loan agent. So it's an additional party to the series that we discussed, because that knowledge about the specific contract is handled by a loan agent. So you have another step for that data flow. So there's been several surveys, regularly service providers survey their clients and say, what's your biggest headache? And consistently, the biggest headache is data. Data is scattered. You've got, it's at the borrower level, the loan agent, the administrator level, in the manager, has to be stacked properly in the financial data, in the reporting data, in the performance and valuation. So it's, I think we get it. Also, yes, the way that data travels can come as a batch through an API, or as an email, as an individual line, or as a portfolio line, etc. So all our providers all our market players are dealing with this. Right, so let's just summarize where we are so far. We have a fast-growing and attractive investment space with a big impact on the real economy, good returns. We have a culture and organization of bespoke and complex nature, non-public data, scattered, inconsistent, unstructured, the high risk of error, naturally, and market and regulatory pressure from retail, but also just from regulator, the AFM, SEC, for transparency and timely reporting. So the industry needs to build scale, needs to improve collaboration between all these players. And the focus, therefore, is on embracing technology. And that industry does it in investing in that technology. We saw that in the infrastructure investments, but also it needs to focus on implementing it and really change its way of thinking into seeing the data as an asset, having a proper data strategy, and automate whatever can be automated in order to speed up and grow. So, this is where AI comes into play. I think when we think about AI and all it can do, the risk is to want to go too fast and too soon. The generative power of AI is huge. It can connect all these quantities of data. We can interact with it through LLM and get the answers that we want. But at the end of the day, first, we know that AI makes a lot of mistakes. There's this number I came across that ChatGPT and Gemini had this analysis about the generally trained AI and checking the accuracy of response, and they found a 50% error rate. Whereas if you train your AI in a segregated manner into your system, you can have like a 95, 99% accuracy rate. But the wider AI still makes a lot of mistakes. The other aspect of why we do not want to go too fast is the quality of the data. Even before AI, when you were running models on Excel, they would say, rubbish in, rubbish out. So the quality of the data you have to start with will impact the quality of what comes out. Which is why we need clean, reliable, and usable data. So the few steps to get to that stage, which will rely on technology. First will be the data collection and integration. So here, it's really, like 101 of data strategy is making sure that from all the data sources, data can be collected in an efficient manner. We have tools such as optical character recognition, reading PDF documents, and then automation to get information into the right stack or system. We've got ETL, extract, transform, and load systems that some tech company will specialize into. So it's going to be about finding the right tools and the right automation that fits this business. But the idea is we want to collect and integrate the data, first of all. Then the data, once we know where it is, needs to be properly monitored and controlled. Another application of AI, which is where here more around the machine learning and also automation, would be to generate data verifications, to identify errors or inconsistencies and correct those errors. So again, several steps from automation to actual AI implementation. So once we have that data that is clean, reliable, and usable, and we know it's accurate and it's properly controlled, is when we can overlay the generative power of AI to create, predictive analysis. And that's the big, exciting thing about AI, that it can help with the investment decision or projections of the value of a fund and so on. And that's really the real added value, but not before got this strong secure data. So I've tried to illustrate the data model. As you can see, I wasn't helped by AI. Hopefully it's enough to get you a sense of how these applications are working together, not just to create one data set, but to really operate with the data wherever it is. But the point is that on the back end of this, it's all of the output to make the investments, to serve the investment purposes of the fund. Eventually, it's the return from investors, but it has to go through origination, servicing, managing your cash flow, reporting, and valuation. Now, I want to say a word about tokenization, because this is obviously the real buzzwords, let's say, of this time. Because really, it is the next step in this data strategy. Because what it will do is it will secure the data knowledge from its source all the way to its final use, without having to, and all the steps in between, without having to centralize the data. So all of these steps of collection, integration, governance, control, and so on, once you have a way to identify the data from the start all the way to the end and follow it through blockchain mechanism, then it will naturally solve a lot of these issues. So here I just want to give maybe a few examples, and I have to give a disclaimer. This is not a paid partnership, but I'm going to throw some names only because I've come across in the research, and I'll be very happy to hear from what you guys know about this. But I've come across in the OCR space, for example, DocSumo. So this is a company that reads and extracts data from lending documents. Dalupa, they automate data collection into your historical data. When it comes to ETL, that's the extraction, transformation, and loading technology. We've got Arcesium, that has the capacity to extract data from your sources, organize it, and then stack it into the right type of reporting. So it's your financial, it's your valuation, it's your investor reporting, and so on. Generative AI, we see the likes of Alpha Secure. So they assist with decision making for managers by searching through research and actually available data to help with the decision making. And then we have full solutions operators such as FundGuard. They're a fund accounting firm that's fully AI operated and actually does collect data that is scattered across various strategies and multi-assets and so on. Arcesium also offers a full solution. On the blockchain side, I've come across Avenium, which is using blockchain technology to promote the development of liquidity and secondary markets in the private capital, which is currently something that needs to be created, because by definition, this market operates in a closed-ended way. There is a secondary market that exists when we bring the assets out of a fund into a new fund, that's a secondary fund. But the actual trading of fund shares or underlying assets can only happen with a boom in transparency, and blockchain would be the way forward. Like I said, no paid partnership. These are just a few names thrown across, and there's plenty more. Didn't check the time. Now, this is fantastic. It's all amazing. But after this vision of the future, I want to bring our feedback on the ground, because the reality is that technology adoption is in the private markets is very slow. And there's a few reasons for that. One is the existing operational complexity. It's difficult to change customized models. It's very slow to see the immediate results. So there's like a resistance to it. Also, it's an industry that's transaction slow. It's not super liquid like the public markets, and therefore it may be a bit of a pain every time we do a transaction, but it's not enough pain to justify the big investments, especially on the private equity side. Private debt maybe has a little bit more of an incentive. Thirdly, there's a talent gap. There is definitely a lot more demand for technology talents than there is offer. So you guys are much in demand. And there's also a need in this space to have financial markets like private capital specialists to integrate into the tech world, and tech specialists to integrate into the private market world, so that these two worlds communicate and understand each other. There's also probably down the line a question of cost and return on investment. How long does it take? When do I see the return from this investment? And the big one, of course, is security and risk management. How do we deal with the data confidentiality? We're handling large quantities of significant and sensitive market data, or actually not market data, private data. There can be worries about integrating data into new processes and losing data at that point, or having data leaks, fraud, error, and also, I guess, the fear of the lack of human impact as you transfer more and more to automation. At which point have you lost touch completely with your data? So all these are factors that are in the mind of our private market participants as they assess the technology. So it's time to be practical now. And how do we approach the transition? Well, I recommend to start with the low-hanging fruit. Basically, take a problem, a simple problem, and solve it, and go from there one by one. It can be as simple as we talked about earlier, rolling in optical character recognition to facilitate the work around receiving information, receiving documents that come by email. So a bit of AI there, OCR, large language model, and then makes your ops on the ground life easier. They're happy, they work on more interesting stuff because they don't need to spend time typing in numbers. Another very simple example, but I've come across that. Simply, you're doing an implementation process, have AI listen to your calls and create your minutes. Saves a lot of time, everybody's happy. I think that this big AI transformation can start really small when people start to see incremental benefits from small, simple tasks. Then you can start to anticipate the bigger ones. There's also the possibility, for example, to install RAG, like captive RAG, to solve queries internally. So start small, run, test, review, evolve, and repeat, and then expand. So this is the approach that a lot of players will take to bring in the technology. Build and retain talent. We talked about it. It needs to be like a communication and really like collaboration between the two spaces of knowing the market and knowing the technology. thirdly, as we get more and more familiar with the use of technology into these various structures, it's important to keep in mind, in order to build scale, to use configuration over customization. Customization, which is a favorite of the private markets because they think they operate very specifically this way, has to be replaced with configuration, which is one large model that you can actually adapt to your needs, but it still has the capacity to grow. And finally, last but not least, it's the data security. So making sure encryption is there from start to finish, whether the data is moving or whether it's staying there, it needs to be securely held. You need audit trail, explainability, compliance-ready models. What we mean by that is all the governance around the AI, which operates with a human brain behind it. So you don't let it roll out of its own, say, suggestion. And very importantly, but IT departments all have this at the forefront of their mind, is the disaster recovery and cyber threat monitoring, such as using ethical hackers to try and push into your system and all that. I guess that's not new, but it really has to be on the forefront of the implementation process. And it's time to conclude. So in conclusion, I want to take a moment to reconnect all the dots. We have a market that's going really fast with a big drive towards retail, but it's also complex and illiquid. So technology is definitely the biggest factor enabling future growth. In fact, the technology adoption is no longer an option or nice to have, it's absolutely mandatory, considering the scale that we're talking about. Also, as we said, the data is the absolute baseline for any innovation. There's no point trying to roll out the big models if we don't have a very, very clear understanding of our data and how it's operating. Clearly, once we have the data, we roll out AI automation, gives us scale and efficiency, but the human expertise really is key. You don't replace judgment and trust or creativity or insight with a machine. So you have to know what you're trying to solve and make your AI solve that. And finally, I think we can expect a really big push towards tokenization and public-private conversions. I actually think that private markets will evolve into more of a diverse space where you will still have the traditional illiquid kind of old school private equity operations, because that market is here. But more and more, we're going to see appearing a more liquid side of the market that will be powered by AI, blockchains, and ultimately will improve the liquidity and transparency maybe for the whole market. So that's it. I hope you have enjoyed this little overview, and I'm very happy to share your views or ask questions. Yeah.
Thank you for that presentation. That was really nice. No, that's fine. So now I want to open the floor now for the Q&A session. So please raise your hands and we'll take it. And also this includes all the participants online as well. So please put in your questions in the Zoom Q&A chat function. So take your questions. Okay.
I ask you, please give an example for the pricing process in the private market. Is it still based on the bid-ask process in a confined group, or is there something like otherwise?
Looking pricing.
Yeah. For example, that the asset price is still based on the bid and ask process, like in the stock market, but in a confined group, or is it in
So if you're talking like funds, buying a share into a company.
Yeah, the price.
They'll actually run the full analysis. They do like the cash flow modeling and the EBITDA and the whole, like when they invest into a company, they invest into the company. So there's no that business is not traded. You could have a bidding war at that point where two funds will be trying to get into that specific business, but they'll have their corporate finance type analysis in the background to estimate the price they want to pay. Yeah.
Any examples for that? You give example for the pricing, how a price is made.
Specific examples, like I said, it's really following the corporate finance, like in the old school in the banks, corporate finance analysis. So you get all of the financials, you get all the management data, speak to the management of the company, you go on site, see what they do, look at the market trends, crunch the numbers, few analysts in the back room, just go through the model and do scenarios, EBITDA scenarios. How much leverage do you put in? How much multiples do you extract from this company? So
Julie, historically, London has prided itself at being at the forefront of a lot of financial evolution. Where would you position London vis-a-vis other global financial centers in this particular field?
I have to say, I have come across a lot of US-based innovation. But, I mean, when it comes to the European private markets, everything happens in London. The funds may be in Luxembourg and a lot in Paris or Ireland, but really the heart of where the management is located is in London. So naturally, the innovation comes this way. But even I think one big driver of the innovation doesn't necessarily just come from the managers, but it comes from the service providers, from pressure from the managers who get pressure from the investors. So it's all coming down. But we see like the big names, whereas the big managers, they are in the US and in the UK, the big names in terms of services, the BNY Mellon, the HSBC, etc. They're also across the two continents. So whatever push innovation comes from America comes over to the UK naturally, yeah.
Julie, you gave a nice overview. Thank you very much for that. On the slide, clean, reliable, usable data, you talked about some broad brush areas where AI can bring business value. I wonder if you could talk to a couple of specific examples that you've seen where any of the AI approaches have clearly driven strong business value.
Yes, well, I can talk about the experience that I've seen at BNP when I was working there. We rolled out OCR, we rolled out natural language processing. So all of these were really helping our loan administration teams on the ground and helping us, to get that clean data. Model at BNP is slightly different because we outsource. So they have their own loan administration system. So it's a question of making sure that the data that comes into that system is the one that they want and the one that serves the client on the other side. Another type of innovation that definitely has benefited the overall solutions for BNP in particular was partnering with a company called Asset Metrics, who were using AI in capacity of capturing the information from the fund accounting system, packaging it through a platform that the investors can access. And investors like that very much because they can log in and see all of their investments in the various funds, and then they can drill into the fund and see information that they have. And so that's really quite powerful. And then they overlay that generative AI as well that the investor even could use and say, show me projections of this investments according to this and that assumptions and so on. So this is the example I've seen because I was involved in the development of solutions, and no doubt this coming from a bank, I've come across. I mentioned a company called Arcesium, and they operate this way, like from the get-go. Just to keep in mind that when we talk about tech companies offering this kind of innovations to the market, they don't offer the bank aspect. Those funds, they still need cash accounts, cash management, and so on. So it's a combination of the two. And for the service providers and the managers to try and find the right combo of technology and day-to-day operations, that's the key. Yeah. Does that answer it? Yeah.
Given you mentioned the private market is undergoing a democratization, wouldn't it be fair to expect that the regulator will step in and require the data provision to be more transparent and market participant to
yes. So there's already some developments that are being done from the regulatory point of view. So for example, in Europe, we've got what's called the LTIF2. So it's the LTIF European Long-Term Investment Fund 2.0. So it's the new version of it, where it's a regulated type of fund, but it has liquidity aspects, like liquidity mechanisms that are embedded into the structure of the fund, so that retail investors, a certain category of retail investors can enter it and not be completely locked in, which would be less beneficial for this type of investors. So there are regulations. There's one in the UK also called it LTAF, which has a similar approach, if I recall it, to do with investments in real assets, but similarly, like bringing liquidity mechanism into the actual structure of the fund that therefore is no longer just closed-ended fund.
Does that impact the data availability?
And sorry?
Does that impact the data availability, the transparency as well?
Yes, it would, because if you have to have liquidity, you need to have data, like valuations on a more frequent basis. Now, it's not going to be like daily liquidity. I'm sure some people would like it, but it just doesn't happen. You can still provide a daily valuation, except it's not changing from yesterday, because valuations only change when the underlying company publishes their reports. So it's really not that fast. On the debt side, it's a little bit more, you can adjust a bit more frequently due to the timings of your lending that are constantly, they can all be on different interest payment periods and stuff. But the other aspect on the regulation is, as we saw in the US, this new regulation that allows for 401k plans to invest into private equity. So there are like certain requirements for those plans for data reporting, transparency, and so on, which will then impact the underlying investments. I'm not exactly sure how it's going to work, but there has to be.
You spoke about start with low-hanging fruits, start small, evolve, and then repeat. Do you have a favorite example that you can share of a project that went successfully?
I mean, I don't have direct experience of going through that phase in the private markets. I have experience of, I work on a board of a credit union. We have to get there eventually, Chikesi, but I've been talking to other credit unions, and they've actually mentioned the same process, saying just start small, make people's life easy. And that experience really works in terms of mainly bringing people over to the idea that you can let go of your processes and replace them. I mean, generally, I think individuals, they're all keen on having AI help them, but it's that gap between, okay, I want this, but how do I get there?
Is there a famous story in the industry that?
I wish I had one. I'd love to have one, but I don't.
Question. You talked about
the reliability of AI, and I think you drew a distinction between large language models and machine learning. And I just wondered if you could expand on that. Particularly, you said that there's like a 50% error rate, which seems pretty high for me.
Yeah, so that's a bit of data. Yeah, I haven't cross-checked it. So it came into a conversation I had with, when I was kind of gathering this research, and I thought that was really quite interesting, because the point of this example was to say, when you again, going through the various steps of rolling in the AI internally, thinking about how you can create a kind of segregated RAG model where you can interrogate your own system. That initially will need to be tested and tested until you can be confident that the accuracy of the answer when you interrogate your own data actually is good. Whereas on the public models, I mean, how do you test that? Because the data is more or less infinite. So I think that was the parallel that was made. And I'm not really an expert on those models, but I can imagine that with the progress, the ChatGPT 5 and so on, every time those creators, they are making sure it gets more and more accurate, but still, there's an infinite.
I mean, the difficulty with AI is it's not deterministic. So when you say test it for accuracy, what are you testing that accuracy against?
Well, exactly, but if you're operating because we're talking about private data, you only have the data you have, which is the one you've invested in. It can be huge or it can be small, depending on the size of the manager or the service provider or the investor, whatever. But it's a limited pool of data at one given moment. So that's what I mean by training your model for accuracy in handling your type of data, which you have in advance made sure is referenced in the way that you want to use it. So the training really starts from the data collection and the data integration stage. Does that make sense? It's already theoretical, but I think that's the.
Sorry, I have a question from one of our online attendees, from Dave. Considering the huge power requirements to run complex large language models, are companies taking steps to mitigate the impact to their stated green credentials?
That's a very good question, and I would imagine that with the pressure on ESG criteria, this is something that would be taken into account. But I would say that probably that kind of pressure would come from more of the way I had this experience in the bank where, as you go and pitch for some business, the ESG aspect comes up and say, yes, we want to do business with you, but we need to make sure that you are actually complying with your environmental responsibilities and so on. And that sometimes can be a real factor. Now, this is on a bilateral basis, but at the investor level, they have the large institutional investors have a lot of pressures also from the regulator to report on their ESG, on the ESG impact of their pools of investments and so on. I mean, at that level, there is also a lot of progress being made in the definitions of how do we report the ESG criteria. So kind of some of it gets lost along the way. But I would imagine in the current market, yes, that needs to be.
I'll probably add to that, you wouldn't use LLMs anymore. It's going agentic with small agents, and you'd have a specific language model. So yes. LLMs are just for general use, and you wouldn't use it in a specific data task. You'd have agents with specific roles. If you were looking at future projections and things, that would be within a specific agent.
Yeah.
So now it's not going to LLMs and ESGs. Oh, that's all.
Okay.
Last year.
That's good to know. Okay, last year. Thank you. This is exactly why we need tech people to speak to finance people and vice versa, because they there's some nuances that go so fast, and I wouldn't know, but thank you. Yeah.
And on data now, you can actually run English against your data. We have a thing, I went for IBM, we've got a thing called DB2 Insights. So you don't have to have SQL anymore. You can actually talk to your data and ask, ask for information from it. Yeah. So, there's many things, everything's moving so fast now.
Yes, absolutely. Thank you.
Yeah, I've got a follow-up question from the gentleman over there. He was asking of the leading companies, and you mentioned you saw a few from the US. What are they doing differently in the US, and what makes them more advanced in AI?
That I would have to look into it. At this point, I haven't really researched why, what I mean, it could be funding, it could be ease of accessing capital I don't know the answer.
It is basically investment. There is no Europe is way behind. Obviously, all the investments in America. I know there's a big I think it's Turin. There's a big centre there that they're spending billions of euros on. But basically, there's no proper AI centres in Europe that can compete with American models. So yeah, hopefully soon. We'll get there. Hopefully.
Yes, question. Thanks for the wonderful presentation, Julie. To what extent is this private market cross-border, and what challenges does it bring, especially when it comes to data crossing borders, deals involving multiple jurisdictions? What are the challenges, and how would these challenges be mitigated, and any examples you can give on these cross-border issues? Thank you. To what extent?
Yes, sure. When it comes to cross-border, again, from my background being more from the financial and operations rather than data rights or things like that. When it comes to cross-border, what tends to happen is that when a fund wants to create an investment that's going to go across different countries, that have like an umbrella fund, usually say in Europe it would be in Luxembourg, and that have, according to the regulation of the various countries, if you need to have a vehicle in that country in order to originate a loan, like it's the case in I believe in Spain and in France, although that may be changing. They would, so you would have an umbrella in Luxembourg, and then where the loan can be extended from a different jurisdiction, you extend it from the main fund. When it has to be local, you'd create a structure in the local jurisdiction and extend the loan from there. Now, how it impacts the data, I have not heard that there was an issue about the loan data traveling all the way up back to the Luxembourg-based fund and to potentially an investor in Canada or in, that I'm not aware of any issue there. It's more of a structure. I think the cross-border aspect is more of a structural and legal aspect and regulation. Yeah.
Another question from Ashok online. Are venture capital companies in effect creating a private equity market?
Well, I would place venture capital loosely into the private equity space. So it's a subset of the private equity market. It operates, as long as you've got a fund investing in the form of putting cash into a business in return for equity shares, it's a private equity. It's a private equity investment, in my view.
Can I ask you, and I know the commercial lending market perhaps better than the private equity market or the private debt market, but I presume there's syndication before deals get released. I mean, if it's not just a one-party deal, everybody knows there's a big deal going down and everybody wants a slice of it maybe, and there's presumably some sort of syndication process that goes on. And if that's the case, then is there how developed is the secondary market then?
Yes. In the lending market does have a secondary market, for sure. The lending market does. So there's really two sides of the private debt space. There's what we call direct lending, where it's a bespoke relationship between the lender and the company. But yes, there can be several funds because the big companies, they know CVC credit, they know Arcmont, etc. So you will have a degree of syndication there. You could also have syndication across different funds in the same manager. So the mechanics of syndication also happens in direct lending space. But the other spectrum of the debt space is the commercial lending, high yield lending, corporate lending, all of those debt that originates from banks. That's a liquid market. Well, it's not super liquid, it's not trading on a daily basis and it's not accessible to everyone, but across banks and funds, there is a market there. So actually in that category of the credit space, do have a degree of standardization of the documentation. There is a degree of pricing that gets exchanged through systems, loan systems and so on.
Because one of the things you have to do presumably is justify your valuation model to your auditors. If you're going to declare a value for your investment every year, you're going to have to go and run that process through an audit person.
Yes, so true. And what happens is that when a market is illiquid, you have to use third-party valuers or your own valuation model, depending where you sit in the requirements for audit. And you can use comparables. I mean, there's various ways that this valuation process is done.
So you end up with the same sort of problems that we had with capital adequacy models, that auditors were not accepting capital adequacy, or the regulators were not accepting particular capital adequacy models, and you run the risk in the private equity space. The regulators will come along and say, well, actually, we don't think your valuations are justified.
I don't have specific examples. I know from outsourcing the services to private equity, private debt funds, that this valuation point is definitely discussed and sorted out through models and things that satisfy the auditors.
Yeah.
I don't have specific examples of why it wouldn't work, but yeah, I see your point, absolutely. I think in practice they do get around it. So
you end up with a judgment call as to whether it's reasonable.
Yeah. I mean, that's the thing with the private market. There's no data.
It's not a black and white sort of solution. It's is it reasonable?
Yeah.